Welcome to This Explainer. If you've been scratching your head wondering why mortgage rates just absolutely refuse to drop, why the stock market seems to randomly freak out every few months, or why the Federal Reserve can talk endlessly about cutting rates, but your money still feels incredibly tight, well, you're in the exact right place. We're going to unpack what is actually going on beneath the surface of the global markets. Okay, let's dive right in.
So what is the biggest threat to the U.S. economy today? Seriously, think about the headlines we're bombarded with every single day. We are constantly being sold a very specific narrative. But traditional financial media is completely ignoring the real answer here because, frankly, it requires a bit of nuance, and it just isn't very clickable. The answer is not the AI bubble popping. It's not China, and it's definitely not whoever happens to be sitting in Washington. If we really want to figure out what's going on with our economy, we have to look past all that loud clickbait noise.
The actual culprit pulling the strings behind the scenes? Japanese government bonds. Yeah, I know. It sounds like literally the most boring asset on the planet. But the reality is that the country best known for attracting tourists and pop culture has actually been the financial duct tape, quietly holding the entire global system together for the past 30 years. And right now, that duct tape is starting to peel.
Rewinding to Japan's lost decades. To see how this financial duct tape was first applied, we got to take a quick trip back in time. Because the foundation of our current economic reality was actually laid over 30 years ago across the Pacific. Back in 1992, Japan saw its massive asset bubble completely burst. Real estate tanked, equities tanked, and the country entered what became known as the lost decades. We're talking a period of virtually zero real growth, zero inflation, and absolutely no wage expansion. The economy was basically stuck on pause. So running totally out of options, the Bank of Japan slashed interest rates to zero, and eventually even below zero. When that still wasn't enough, they brought in something called yield curve control. This meant they officially capped long-term bond yields. They essentially took superglue and pinned interest rates right to the floor,
Which kicked off a massive global shopping spree. Put yourself in the shoes of a giant Japanese pension fund or life insurer for a second. You're sitting on a billion-dollar investment portfolio, but because of that superglue we just talked about, your domestic government bonds are paying you exactly 0%. Nada. You've only got two choices, right? Accept absolutely zero return on your cash, or take your money and go shopping overseas. Obviously, they chose option 2. Japanese institutions went on a multi-decade global shopping spree, which effectively turned Japan into the world's ATM.
This birthed what is known as the yen carry trade. It's simply the practice of borrowing money in Japanese yen at those near-zero interest rates and using that cash to invest in foreign assets that pay out higher returns. This multi-trillion-dollar loop became one of the absolute biggest sources of liquidity for the entire global market.
Let's actually walk through how this free money loophole worked. Let's introduce our hypothetical investor, Bob. Step 1, Bob goes to the Japanese markets and borrows a bunch of yen for practically nothing, 0% interest. Step 2, Bob converts that yen into US dollars. Step 3, he takes those dollars and buys US treasuries yielding, let's say, 4%. And step 4, Bob just effortlessly kicks back and pockets that sweet spread. And guess what? Huge institutional capital did this exact same thing, over and over again on an incredibly massive scale.
And why stop at treasuries? With borrowing costs at basically zero, this capital flooded into everything. Mortgage-backed securities, tech stocks, real estate, emerging markets. Honestly, if it had a pulse and yielded more than 0%, they bought it. At its peak, this trade was estimated to be in the trillions of dollars. The global markets have essentially been running on free Japanese Wi-Fi for years.
But here comes the 2024 breaking point. This whole massive multi-trillion-dollar global structure relied on one single foundational assumption to hold it all together. The assumption that Japanese yields would just stay near zero forever. Well, in 2024, that assumption absolutely shattered.
17. The Bank of Japan officially killed their yield curve control policy, and they hiked interest rates for the first time in 17 years. Just let that number sink in for a second. For nearly 2 decades, the money printer was perfectly predictable. And then, bam, suddenly they raised rates.
And the shockwave was immediate. Following that rate hike decision, the U.S. S&P 500 dropped 6%, and Japan's main index, the Nikkei 225, it totally cratered, plummeting over 12% in a single day. That was the worst drop they'd seen since 1987. It was a massive, glaring signal that the global markets were officially spooked,
because that financial duct tape was finally peeling away. Because look, the math just totally flipped. When Japanese yields rise, borrowing in yen becomes a whole lot more expensive. On top of that, hedging against currency risk, also more expensive. The free money trade just isn't free anymore. Suddenly, that 4% US Treasury our guy Bob was buying isn't the slam dunk guaranteed win it used to be. And when the math flips, the capital flows flip too. This kicks off a terrifying reversal called repatriation. That's the massive movement of investment capital out of foreign markets straight back to its home country of Japan. Investors are waking up in a cold sweat to a very uncomfortable truth. The absolute cheapest source of global liquidity for the last 30 years is drying up.
So let's talk about the impact on your money. How does this massive domino effect actually hit your wallet? We really need to confront a huge misconception about how the economy actually works here at home. Legendary investor Ray Dalio hit the nail on the head when he said, the bond market is the basis, it's the backbone of all markets. It's the baseline risk-free rate that dictates what every single other investment is going to return. When the supply and demand for bonds breaks down, man, every other asset class feels the pain.
And this is exactly why obsessing over the Federal Reserve is honestly missing half the picture. We're all glued to Jerome Powell's press conferences, waiting for rate cuts, right? But the Fed primarily controls short-term overnight rates. Long-term rates, like the 10-year, 20-year, and 30-year yields, those are driven by raw supply and demand. And for decades, Japan was the reliable, completely price-insensitive buyer bringing that demand.
Which traps us in some pretty terrifying math. The United States is currently running trillion-dollar deficits every year, meaning the Treasury has to issue a mountain of new debt just to keep the lights on. But they have to issue all this massive new debt at the exact same moment our biggest foreign buyer is packing up their bags and walking away.
This creates what is called a steepening yield curve. Think about it. If one of the biggest buyers leaves the market, you have to offer higher yields to tempt new buyers to step in. So we end up in this weird scenario where the Fed might cut short-term rates, so short-term yields fall, but long-term borrowing costs absolutely refuse to budge because that global demand just isn't there anymore.
And then come the downstream dominoes, the incredibly painful, real-world consequences of those high long-term yields. Because that 10-year yield is the baseline for everything. When it stays high, stock valuations get compressed. Mortgage rates stay stubbornly high, making housing feel literally impossible to afford. Corporate credit tightens up, business growth slows down. Basically, the whole system just chokes.
Which brings us to the final, sobering thought of this explainer. What happens to the U.S. economy when our biggest buyer stops buying? It's the multi-trillion-dollar question the mainstream media isn't really asking, but it's the exact question that's going to dictate the future of our financial markets. When global liquidity dries up, the cost of money changes absolutely everywhere. Keep your eyes glued to the bond market, folks, because the real threats usually aren't the loud ones, they're the ones hiding in plain sight. Thanks so much for learning with me today.